Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. We know you have questions. We know because you send them to us. And today we're going to answer a whole bunch of them. And oh my goodness, are there some great questions? It's what we call Ask the Guys. Your questions, our answers on the Real Estate Guys radio program. For thousands of years of human history, silver has been recognized as money. Then in 1965, the United States took silver out of the financial system. But did silver stop being money? Smart investors don't think so. And ever since, when there are concerns about the quality of the currency, alert investors seek shelter in silver and gold. As the size and frequency of major financial crises grow, silver is attracting a lot of attention. To help better understand the what, why, and how of silver, watch the free 9-part series, Making Sense of Silver. Everything you always wanted to know about silver but didn't know to ask. Featuring 30-year precious metals veteran Dana Samuelson. Send your email requests to silverseries@realestateguysradio.com. Whether you own silver now or you're wondering if it's too late, email silverseries@realestateguysradio.com. Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. With me, as usual, it's our co-host and financial strategist, Russell Gray.
Hey, Robert.
You know, week after week after week, here we are talking real estate, and real estate doesn't really change that much, but what changes is, oh my gosh, everything else, right? I mean, COVID and, police riots, all the things that are happening, and yet every real estate investor knows that time can be your friend or your enemy. If you do it right, time is your friend. If you do it wrong, time is your enemy. And we know that because you tell us that in your many, many questions. Every week we get tons of great questions from our Real Estate Guys listeners. And today it's another edition of Ask the Guys. Here's how it works. You submit your great questions. We go through them and figure out the ones that will have the most appeal to a broad audience. And we do our best to get some great ones on the air. We just have two caveats to this show. The first is that we do not give advice. We give ideas and information. Advice is given to you by a professional, which leads into our second caveat, which is we are not tax or legal professionals. So anything that you hear about on a show like this, make sure you go check it out with the pros. With that, let's jump into it. Question 1 comes from Tim in Grand Haven, Michigan. Hey guys, I've been listening to your podcast for a few months now with the hopes of learning as much as I can before transitioning from investing primarily in companies to the rental property market. I can't tell you how much I've learned, but I'm well aware I haven't even scratched the surface of what I need yet. My question for you, though, what is up with debt? I'm aware that I'm probably one of the most debt-averse people around, but I keep hearing and reading how it can be used for good. I'm 36, married with 4 kids. I own my own home and it's paid off, and I'm hoping to switch to real estate with about $600,000 in cash. My plan has always been to buy property in cash with no debt, but I hear so often this might not be the best way of going about it. Can you please help me understand how the upside of debt outweighs the downside of the risk that it brings? You guys are doing an awesome job. I can't say how much I appreciate all you do. All right, well, you did say it, and we appreciate that, Tim, and that's why your question is first, by the way. But this is a great question. Actually, the reason we want to start with this question is it's kind of a fundamental principle. One of the great benefits of real estate is leverage, the fact that we can use debt. And to explain it in a way that makes a ton of sense, I think the man for the job is our financial strategist, Russell Gray.
Yeah, absolutely. And this is such a fantastic question, Tim. So I'm happy we're kicking off with it. First of all, there's nothing wrong with being debt averse when you're talking about consumer debt. When you have to pay interest out of the sweat of your own back, yeah, you don't want to be in debt. You only want to be in debt when there's positive arbitrage, meaning that you're going to make money on the borrowed money. And so even then, you got to be careful because whatever you're going to do the debt service with, you have to have a lot of confidence in. Obviously, a portfolio that has no debt in it is almost bulletproof. And so it is on the extreme category of safety. With that said, it really dilutes your return, and here's why. If you were to say, for example, have a market where real estate was appreciating at 5%, meaning a $100,000 property a year later would be worth $105,000, you make a $5,000 equity growth on your $100,000 purchase equity because you paid cash. But if you were to put down 20% down and get an 80% loan, now you own 5 parts of real estate. If you divide 100 by 5, you get $20,000 per component. Your down payment component is your money. So your risk capital is only 20,000. You've mitigated risk by using debt, benefit number one. Number two is you're going to have four components, four $20,000 pieces, $80,000 total provided by the bank. You get to keep all of the upside. So the $5,000 appreciation that occurs on the total $100,000 all accrues to the equity, your $20,000, and none of it goes to the bank, their $80,000. So if you divide 5 by 20, you're going to find that your return is 25% because you're getting 5-to-1 leverage on your money and you got a 5% move. So the reason this is important is we're in an inflationary environment. If inflation is the cause of your equity growth on your property, you're not really making progress. The only way to make progress is to grow faster than inflation. Debt allows you to do that. The last reason to use debt is when you have equity in the property, it's exposed to predators and creditors. And there's no way to shelter it or hide it because it is part and parcel of the property. When you don't have the equity in the property, it's not there to be exposed. And so there's a whole different thing on asset protection I could go into with respect to that. But those are the biggies. And then when you do the math on the diminished cash flow, on the debt, the cost of the debt, what you're looking for is a positive spread. So say your property has got a 6% cap rate, or you put $100,000 down and you're cash flowing 6% net on the $100,000. But you only put $20,000 down, and then you have to look at the cost of the debt. If the money costs you 4%, you're actually going to make a little bit of a profit and improve your cash flow on that. And then the other part is if you do have $100,000 of capital, instead of buying just one property and having single point failure, you could buy 5 properties with 5 $20,000 down payments and 5 $80,000 loans. And so you control a lot more top line property. You have diversification of income. You get a lot more depreciation tax benefits. So there's lots and lots of reasons to do it, but that's kind of the nickel tour.
Well, and another reason to consider that diversification is you might be able to diversify by neighborhoods or states or even countries rather than have all your eggs in one real estate basket. Another big point today, Tim, is that interest rates are at record lows. So your borrowing power is incredible right now. And that is another reason to consider debt. Now, I will say many times over the years, I have found it very beneficial to have at least one free and clear property in my portfolio. For whatever reason, when you apply for a bank loan, lenders seem to love that. And often people choose that to be their home. If you don't want to have debt on your home, okay, you don't have to. But there are reasons to consider that as well. So we're not here to talk you into going into debt. We know people that invest in real estate for cash and they do just fine. But leverage can magnify returns. A quick part of the risk side, your lender is going to make sure you don't take undue risk. Yeah, the property might be at risk if you're not able to pay the mortgage. We always say that the mortgage controls the property, so if you can't pay the mortgage, you lose control of the property. That's no good. But your lender's going to make sure that you're not over encumbered, and that's a big part of it as well. Sometimes your lender gives you more borrowing power than you feel comfortable with. That's okay too. But I think if, as Russ likes to say, if you do the math will tell you what to do. I think that the leverage and the magnified return is going to outweigh any risk. Then you add the fact that interest is deductible and that you can diversify, and it makes a ton of sense. It's Ask the Guys. Your questions, our answers. Question 2 comes from Kenny. He's in Indio, California. Hey guys, is it better to do a takeout cash loan from my home or from a rental property? I have plenty of equity in both. Also, do you guys have any secrets on out-of-state rental property? Well, those are two different questions, and we'll kind of cover them both. Obviously, if you have a lot of equity in the home you live in, and you have a lot of equity in a rental home, you could go to either, but there are some strategic reasons why one or the other makes sense.
Yeah, so it's going to be cheaper to get it out of your home. With that said, it's not so much better in terms of cost, it's better in terms of risk. When you put more debt on your home, you're taking a risk. So the risk is going to be predicated on what do you do with the proceeds. If you're very conservative with the proceeds, if you invest the proceeds in something that is going to provide enough cash flow to cover the cost of acquisition and make you a profit, and it's very conservative, you might be willing to do that, and that might make some sense. I personally am a big fan of converting equity into precious metals, and there's a whole strategy for doing that. But whatever you choose to do, just be aware that you probably want to be more conservative with whatever you're doing with respect to your own home. As far as a rental property, you won't be able to get as high a loan to value, meaning you won't have access to as much of the equity. It's going to cost you a little bit more. And again, same thing. Whatever you're doing with loan proceeds, that's really where the risk reward. For both of these questions, the real thing to take into consideration is what we call risk-adjusted return. It's not just the best return. I mean, you can get great returns taking outrageous risks. Problem is, if you hit big, you win big, but the odds are you're going to lose big. On the flip side, you can play it so conservatively that things you don't see and feel, like inflation and counterparty risk, end up taking all of your benefit, and you end up with a low return. So I think ultimately you just need to take a look at the cost of doing it, what you're going to do it with, and then how secure you are in the rest of your portfolio and balance sheet and cash flow, just to make sure that if something were to go sideways with whatever you do with the proceeds, that you're not going to find yourself homeless or in foreclosure.
If the properties are in the same state, you might talk to a mortgage broker who can do the analysis for you just to confirm what we've said. As far as your question about secrets of out-of-state rental property, yeah, I don't know that they're secrets, but they're definitely opinions. First of all, when I started investing in real estate, the first 6 or 7 years I owned property, I only bought in one state, and that was the state I lived in. Fast forward a few years, and I completely changed my mind on that and developed the whole concept of live where you want to live, but invest where the numbers make sense, because I found better markets to invest in. So to me, to just bring it home, first of all, you may not live in a great real estate market, but there are great real estate markets. So I'm a fan of going out of state unless you are in a great market. The way to really make that happen is with excellent team members. The primary team member, of course, your property manager. And never hire a property manager based on price. You don't want the cheapest, you want the best, and a great property manager will more than pay their fee. It's one of the smallest fees we pay in real estate, and it's arguably the most important. So you want a whole team, though. If you're going to invest in a market that you don't know well, you need a great broker in that area. You may need a great lender. Some lenders can work across state lines, some can't. You're going to need a local attorney in that state and so forth. So just make sure you get your away team, the team in that marketplace together, and get good referrals, and make sure you're dealing with reputable folks. That is the key, in my opinion, to out-of-state rental property. Do recognize laws, including tenant-landlord law, are different. The way escrow closes is different. It could be an attorney, it could be an escrow company, it could be a title company, lots of different ways. And if you don't know, make sure your team does. It's Ask the Guys. Your questions, our answers. One more I'd love to fit into this segment because it's kind of a theme, and that is financing. This comes from Dahlwinder in Houston, Texas. He says, hey guys, I bought a single family residence in 2010. Its current estimated value is $145,000. The loan amount left to pay is $35,768 at the rate of 5.125% for 30 years. I'd like to get the equity build up out and invest in another property. Is it better to refinance or to sell and do a 1031? Thanks. Well, those are the two ways to go. You could refinance, get a new loan, probably at a lower rate given today's rates, pull some cash out. It would extend your amortization period, but that would be a way. Now you'd have the money and you'd go buy another property. If you sell the property and do a 1031, that's a tax-deferred exchange that allows you to take the proceeds forward and you don't face taxation. So I think it's a big old, it depends.
Yeah. So it really comes down to, you got to break the question down into a couple components. The first thing is, if you didn't already own the property, the original property, would you buy it again? In other words, do you want to keep this property long term? And you want to look at it in terms of the market, its condition, the demographic it serves, the management you have in place. And then you want to compare that to all of the other things that you could do with the proceeds, because no matter how much you're able to refinance, you're still going to leave a chunk of your time, energy, focus, and equity in that property. So if you decide you want to keep it, then obviously the refinance is the way to tap the equity. If you decide that you don't, then yeah, the 1031 is the way to go. The thing about the refinance versus the 1031 is typically the refinance transaction costs are going to be less, and the 1031 stress and transaction costs are going to be higher. But If you're exiting a property that you don't want to be in long term, then that's probably a good thing to do because you're just compressing the stress today that you're going to face later. But if it's a good long-term hold, I would refinance and then keep both.
You know, Tim, from question number one, to help get your mind around debt, this is a property where the loan has now been paid off for almost 10 years and the loan balance is down. And yet if you look at his return on equity, it's not very good because he owns so much of the property now. So by refinancing and getting more out of the property, it's also going to bring that back into alignment. So again, you're trying to get your head around what debt makes sense and doesn't make sense to sell. And every situation is a little different, but hopefully you got some ideas there. We've got lots more questions when we come back. It's Ask the Guys on the Real Estate Guys radio program.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
In uncertain times like this, it's great to know there are two things you can always count on: high demand for affordable single-family homes to live in, and Terry Kerr's amazing Memphis team at Mid-South Home Buyers to find, fix, and manage the next addition to your recession-resistant real estate portfolio. The Memphis market is logistics and distribution dynamo with an economic engine that's essential to moving goods and critical supplies all over the United States. Quality rehab, proven profitable property management, affordable rents, and solid ROI make turnkey property investing through Terry's team a dream when it matters most. To learn more about Memphis and Mid-South Home Buyers, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Hi, this is Tom Wheelwright, best-selling author of Tax-Free Wealth, and you're listening to Real Estate Guys Radio.
Welcome back to the Real Estate Guys radio program, heard every weekend on this fabulous radio station all the time at realestateguysradio.com. We're glad you're here because it's Ask the Guys. Your questions are answers. If you have a question for the Real Estate Guys, all you do is go to our website at realestateguysradio.com and click the button that says Ask the Guys. Question number 4 comes from Noah in Denver, Colorado. Hey guys, is the Secrets of Successful Syndication event in September still a go? How will it be conducted given our recent health crises? Will there be options to participate online? Thanks so much. All right, well, we've been getting this question a lot. In fact, 3 or 4 of the questions today were about that very thing, and we have just made the decision and are about to make the announcement that the Secrets of Successful Syndication the last weekend of September will be a virtual event. It's what we did in March. We do this event twice a year, whether you're a passive investor trying to figure out how to vet a syndicator and find deals, or if you're someone who has gotten to that point in your real estate career that you think the next step for you is to raise capital and build a real estate business around that. This is an awesome event. In March, we had to make that decision to switch from a live event to a virtual event the days leading up to it, and it was crazy. Now, with everything the way it is, there certainly is an argument to be live, but there's an argument not to be. It's our sincere hope that by the time we do the next event early next year, we'll be back together, because a lot of the benefit in going to live events is getting to meet people and all that kind of stuff. But you do have to be careful today, and we're very aware of that. So it will be a virtual event, and the good news is that means you can attend from anywhere in the world as long as you can handle the time zone change. Not only that, we'll be recording the whole thing, and we make that available for a couple of weeks to the attendees, just in case you want to go over it again, or you had to step out for a segment, or any of that. But I would say that as challenging as it is to have to shift gears and do a virtual event, First, we got great feedback from the last one. And second, there's an argument to be made that now is about the best time ever to consider real estate syndication.
Yeah, absolutely. I mean, I think the obviously being able to participate when maybe you wouldn't be able to because of travel restrictions or expense restrictions or schedule restrictions, because it's one thing to attend event, it's another thing to have to travel. So as much as we love travel, it actually ended up working out great for many people who wouldn't have otherwise been able to participate. And everyone said, yeah, it was fabulous. But the bigger thing is what's going on in the world right now. The Federal Reserve, if you haven't been paying attention, has printed trillions and trillions and trillions of dollars. The federal government, which is not the Federal Reserve, is spending trillions and trillions of dollars. And so you have these stimulus bills and these big treasury issuances, and all of that is designed to get the money into circulation. That's why you see the stock market going up and bonds going up, interest rates going down. This is dollars going into these paper assets. With that said, the thing about the paper assets is people who are gaining equity, if you will, or gaining capital gains in these paper markets realize that these paper markets are a sham. And what's happening is people are buying houses. Home sales are actually up. People are buying gold. Gold price is way up. And these are all indicators that there's an appetite out there for real assets. So there's plenty of money out there. What there doesn't exist enough of is shoppers, right? If you can think about it, if you're not allowed to go to the grocery store, you can kind of call one of those services that goes and shops for you and brings it to you. That's very convenient. Well, imagine being a high net worth person with a bunch of cash, but you don't know where to find a real estate deal. You've never done a real estate deal in your life. So you think, okay, I could buy a home. Maybe I'll buy a second home. Now what? Right? And none of those things cash flow because you don't even understand that. Or let's say that you're a retiree and you're looking for income and they keep lowering interest rates, negative interest rates that are just basis points, not even a full percentage point on savings, right? Those people need real yields that are going to exceed inflation. Real estate can provide that. It can do it in a safer way because it's backed by real collateral, a real asset. So people are starting to wake up to this that have never been in the space before, but they need shoppers, they need syndicators, people who can aggregate their capital with other people's capital, go into the market, find the deals, vet the deals, arrange the financing, install the property management, oversee the whole thing, and you get paid fees and profit sharing for doing all of that. That's what the training is all about, to explain to you what the business is, how the business works, legal considerations, marketing considerations, a whole bunch of operational considerations, business modeling, lots of people who have been there, done that, panels. It's a fabulous event. It's live, so it's not like it's a pre-recorded thing. We're there delivering the content in real time, talking about whatever's going on in the world at the time we deliver it. But now's the best time. It's actually, we got onto the syndication bandwagon in 2011 because we thought it was great. And then in 2012, they did the Jobs Act, which turned into allowing syndicators to be able to advertise at the end of 2013, got better. And then we started having all this stuff going on in the financial world. It got even better. And now I think people are realizing there's going to be some bargains as we go through this difficult time. And so it actually even got better because lots of money and lots of bargains. You get in the middle of that, which is what being a syndicator is. You've got a real business opportunity.
If you want the details and you want to be part of the secrets of successful syndication, all you have to do is send an email to syndication@realestateguysradio.com and save your spot. It's Ask the Guys. Your questions, our answers. Our next question comes from Randy in Reinholds, Pennsylvania. Hey guys, I love your show and the wealth of knowledge and information you guys share with your audience. We've been hearing a lot about getting liquid by tapping equity, credit lines, or selling marginal assets. We also are expecting some amount of inflation due to QE infinity. How do you balance the need for cash versus the likelihood of a falling dollar eroding your cash purchasing power? Great question, by the way. There's more. Precious metals are a good liquid option to store a percentage of your wealth. Do you have any advice on other relatively liquid assets to park dollars? Looking forward to hearing your perspective. Thanks, Randy. All right, Randy. Well, very astute question. Here's the thing. This old adage about the bank will never loan you money when you need it But when you don't need it, they're willing to loan you a ton. And it kind of works that way when you're trying to get your mind around your cash needs. If we're sailing into headwinds, we'll have some cash would be good. But if we know that the value of every dollar we hold in our wallet goes down, meaning its purchasing power is eroded bit by bit, month by month, year by year, like it has been for over 100 years, then we don't want to hang on to too many dollars. It's why Robert Kiyosaki says cash is trash. It's not that he doesn't like the things money will do for him. It's that when you hold your money in liquid cash form, it virtually goes down in value all the time. So we agree that precious metals can be a great hedge, a great store, a great place to keep some of your wealth. And as we've seen in the last few weeks and months, the price has reflected that. But remember, metals don't really change their value. So when you see the price of gold go up, that really means the dollar has gone down. So how do you balance having enough cash, because there's reasons to have cash, with not losing all the value as the dollar continues to erode?
Yeah, well, first of all, it's a great question, and I'm going to kind of throw a monkey wrench in it because you're dealing with a couple of different things. Obviously, getting liquid is meaning that you can pivot into the currency du jour as quickly as possible. Obviously, in America and in real estate, dollars is that currency. And so if you're going to be doing real estate deals, and that's what you contemplate doing, dollars are great. I mean, that's where you want to be. If you're aggregating cash in anticipation of real estate prices falling, then really in terms of your purchasing power, your dollar is going up in value. Might be going down in value in other areas, but in that arena, it could actually be going up. So whether you decide to hold metals or alternative currencies or whatever is really going to be dependent upon what it is you're holding the cash for. The bigger risk is counterparty risk. If you're past $250,000 in an individual bank account, you could be dealing with a bail-in type situation if the banking system were to really come under a lot of pressure. So I'm a big fan of having a chunk of cash outside the banking system, and that's just to meet your immediate cash needs. If you do have cash inside the banking system, if you have multiple entities or different people in your family, you can spread it out in such a way that your accounts are all qualifying for that $250,000 coverage. That's probably a smart thing to do. Sitting in dollars for the short term is not bad if your anticipation is I'm going to be out looking for bargains and I want to be able to move quickly. If you're trying to set aside and store liquid wealth for the long term, then yeah, precious metals, I think, is the hands down favorite. But, you've got friction because you're going to have transaction costs going in and out. And depending on whether you're buying gold or silver and how you carry it, you may have some storage costs. And there's, always a little bit of risk that someone would steal it from you, depending on where you keep it. So all of those things have to be taken into consideration. I really look at precious metals as a better form of equity. If you think about having real estate equity in your properties, if you have equity in your balance sheet that is held in the form of precious metals, you don't get in and out of there like a checkbook, but you're holding it for the long term. But anything that you want to store your wealth in, if you want to get outside of dollars, what you want to be in is something that there is almost always a bid on, meaning someone will almost always want to buy it. And there's very little friction in doing the transaction, and it's safe from counterparty risk. Just understanding that if your asset is concurrently somebody else's liability and that counterparty fails, then your asset is no good. Okay, so just be aware of that. But I think cash in the bank, cash outside the bank, make sure you're under that $250,000 limit. Precious metals outside of the banking system in your possession, physical, not bad for the longer term. And anything else you can think of that you could easily get a loan on at a favorable rate where you could keep the upside of the asset. And gold fits this category, by the way, and then also go out and make the investment and take advantage of the bargain. So a lot of information there and a quick answer, but you're on the right track.
Now, part of the reason we have been fans of tapping credit lines is last time around, we saw credit lines disappear overnight. So all of a sudden, you've got a nice line of credit on your house and a couple lines of credit on your income properties, and you feel like if I had to, I could write a check for $150,000. Except overnight, it disappears like it did last time. So if you've got the money, then that's not a problem. That's different than because the dollar's going down in value. Now, you asked if we had any other advice on relatively liquid assets to park dollars, and I absolutely have one, and that is an apartment building. Because what an apartment building does is convert every month to dollars, and guess what? As dollars erode in value, rent goes up. So what you get is cash flow. Now, you say, well, real estate isn't liquid. Except for the last many, many, many years, the demand, particularly of apartment buildings, more than single-family homes, more than almost any real estate, has been so strong that if you were willing to list at a price anywhere near market, you could get a fast sale. And I think that's still happening today. So if you're not looking really for true liquidity, you need cash. Even gold, it takes something to convert. And as Russ said, there's a big cost to do there that you don't have with cash. And it can be percentage points. So I like apartments. It's not that I don't like single family houses. It's just that the demand side, how liquid is it? There aren't as many buyers, but the buyers are real. So that's our perspective. Great question. When we come back, we've got more questions. Plus, we're going to ask you a question as we play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Don't be like Charlie, who scans the internet for IRA information, often getting bad information from copycats who have no idea what they're doing. You deserve to work with a reputable firm that specializes in one thing, the EQRP. Lucky for you, Congress just made it possible for you to get up to $200,000 out of your current 401k or TSP, so you can invest that money in real estate or even your own business. Even if you're still working, it's possible to get access to all this money tax-free. Whether you're a full-time investor, a doctor, or a government employee, even if you have employees, the EQRP is your secret weapon. You'll never see this strategy in Money Magazine, only here with the Real Estate Guys. Every major accounting firm in America is quietly sharing this strategy with their wealthy clients, helping them get their funds freed from 401k jail. Hi, I'm Damian Lupo, and we have your solution. With the CARES Act expiring soon, this strategy will be gone forever. The EQRP company is ready to help you unleash your retirement funds now. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report today.
Hi, this is Simon Black from sovereignman.com, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, great news. The Crisis webinar series has begun. Yep, all the folks that signed up have been getting that great information. If you're not one of them, all you have to do is send an email to crisis@realestateguysradio.com. This is amazing. We talk to lots of our big brain friends, and it's hours and hours of great content. And it just takes one email. crisis@realestateguysradio.com, and it's completely free, and there's not even an upsell, so go check it out. It's Ask the Guys today, our answers to your questions. Before we get back to those great questions, we're going to ask you a question as we play real estate trivia, a chance to win a prize by knowing today's real estate trivia question. Just a minute, I'm going to give you a question about a U.S. state, and if you're the first person to get the right answer, you're going to win a really cool book. It's called The One Thing That Changed Everything, a collection of awesome, awe-inspiring stories put together by our good friend Kyle Wilson. That book could be yours if you know today's real estate trivia question. Last week, we had the amazing living legend Dennis Waitley with us. We asked this: in the Chinese culture, every year is represented by an animal. What animal represents 2020? Well, lots of folks knew that 2020 is the year of the rat. It's actually the year of the metal rat. Here's our real estate trivia question for this week. How did the state of Nevada get its name? Yeah, all the states were named for something or some reason, most of them anyway. How did the state of Nevada get its name? If you know or you just want to guess, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. You want to include your name, the answer to the question, and your physical mailing address. So if you're the first person that gets it right, we'll send you the one thing that changed everything. That's today's real estate trivia question. It's Ask the Guys. We do the show every 6 or 8 weeks. And boy, there were a lot of questions in the grab bag this week. This next question comes from Doug in Lancaster, Pennsylvania. Hey guys, thanks for all the wisdom you guys share. Your ability to break down complex theories in ways average guys like me can understand is amazing. By the way, when you start out your question with a nice compliment like that, there's a much better chance it gets read. So thank you for that, Doug. My question is, can you compare cap rates of a small business to the cap rates of real estate? For example, in my area, a good cap rate on a multifamily real estate deal would be around a 9 cap. In your guys' opinion, how much greater would a cap rate need to be on a small business for you to prefer the returns on the small business versus the return on a 10 cap real estate deal? I have the opportunity to buy into a well-established specialty trade business at a 50 cap. The NOI for last year is half the purchase price. Can businesses be evaluated with this metric? Thanks in advance, Doug. Well, Doug, that's a great question because it's always compared to what? And our premise is before you're a real estate investor, you're an investor. And the reason you're an investor is you want to put out your hard-earned money into the marketplace and have it come back with friends. We love the vehicle of real estate to do that, but it's not the only vehicle. We've talked about precious metals. We don't view those as an investment because you don't create any return. But businesses can create an immense return. However, the vast majority of businesses fail. A lot of real estate fails, but it's not the majority. So you really can't compare apples to apples, but I will tell you this, different businesses, based on the type of business they are, have different multipliers for which they sell. And so some businesses sell for basically 1 year's gross income. Some business types sell for 3 times net income. So you really have to get a lot more into the weeds when you're looking at buying a business based on what the business is. And of course, the risk parameters different, how active it is. There's a lot of things to consider. We wouldn't sway you away from buying a business, but you really can't use cap rates as an apples for apples comparison.
Well, I do think that anytime you're evaluating an investment, you're going to deploy capital, what you're concerned about, again, as I mentioned earlier, is a risk-adjusted return. The reason you're getting a much higher return on capital there is you're taking a whole lot more risk, probably, meaning you have to know something about the business. A business as a going concern is great, but there are a lot of businesses that have really nice financials based on last year that are completely shut down right now, and their prospects are grim. So you have to have the ability to do that. You cannot be unsophisticated being an apartment investor, let's say, but the business model of an apartment building is pretty easy for the average person to understand. You can go and you can pretty easily compare to see the market rents, the condition of the property. You can get a variety of third-party appraisals and inspections to make sure you understand what you're buying. You can hire competent property managers and have an abundance of backups for that vital function. And so it's pretty easy to understand what you're getting. And most of the assumptions in the P&L, you can go check yourself. It's not hard to check what the utility bill is going to be or the property tax is going to be or the insurance costs or whatever. So when you underwrite a business opportunity, you have to look at it the way you would a real estate deal, except there's going to be a whole lot of things probably in a specialty trade business you may not know anything about. And if it's dependent upon management, assuming you're buying it as an investment, meaning you're not going to be an owner-operator, then you're really dependent on that man or woman or team that is running that deal. And you have to ask yourself, if they quit, if they get sick, if they hate my guts, if we don't get along, they walk, then what? Is there another person there for me to back up? I mean, real estate is easy because you don't have to be that smart, right? If you're going to invest in businesses, you just have to be a lot smarter. And I think the real rule of thumb in real estate or in any investing, don't ever buy anything that you don't understand. And if you're truly going to be hands-off, then you need to make sure that every vital function to make that thing viable for the ongoing production of income is in place and redundant, and you know how to replace a part if it breaks. because as an owner, that's going to be your responsibility. You might not be operating the business, but you're going to be responsible for hiring the operator and replacing them if they don't do the job or if they leave you.
Just like it's our practice to get an appraisal on a piece of property to find out what its value is from an independent third party, you can do the same thing with businesses. There are business brokers. There are folks in those spaces. So little homework and you'll be able to tell if the price being offered is a good one. But do keep in mind, there's a lot more to running a business, a lot more moving parts. Our next question comes from Chris in Corte Madera, California. Hey, I love the show, and I enjoyed a live seminar back in San Mateo, California 15 years ago you guys did. Wow, are you sure it wasn't our younger brothers? My question is, I've always wanted to invest in multi-unit apartment buildings for students in college towns, as it seems college towns have been historically stable microeconomies, and parents will co-sign the leases. That's true. How do you think those towns and off-campus student housing in particular will fare after COVID? Thanks. Well, Chris, I've been a big fan of this exact type of housing. It's where I got my start. I was a residential property manager on a 48-unit apartment building a block from a university, and this was our wheelhouse, and we expanded our reach to lots of buildings around the campus, and so know this niche very well. And I also am very concerned. I've been concerned, frankly, for a couple of years because the entire model of higher education has changed. I watched my 15-year-old son become an accomplished piano player from his teacher, YouTube. Boy, when I was growing up learning music, I had to go to a music school and sit in front of an instructor and be there for an hour. That's all gone. And today, colleges are having a hard time retaining and sustaining their numbers, and COVID just put a big old monkey wrench in that thing.
Yeah, and I think the other thing is, and I'm going to say this, and it may ruffle some feathers, it's not meant to be a slur, it's just an observation, colleges tend to be among the more politically correct, which means that if it's in vogue to be distanced or shut down or to try to do things remotely, they're going to do that for the longest possible time, in my opinion. Not saying it's good or bad, but I think it's a fair estimation of the culture. That being said, at some point this thing will be over, and I think there's going to be some weak hands shaken out. So if I was looking at the space right now, I would look at the financial strength of the university itself. Is it a private university? Is it well endowed? Or is it a municipal or a public school? And who's paying for it? And how strong is that municipality? And then ask yourself if it's going to endure, because not all of these institutions are actually even going to survive. Is it the only game in town? If the college were to go away, is there still an investment opportunity? Are these single-purpose buildings and units, and the only reason they exist are viable because of the school? We say all the time, you want a multi-pillar economy, and so don't, just because it's a college town, if it's the only game in town, just like a prison town, just like an oil town, if it's the only game in town, and we're finding that no industry is immune, then you just want to make sure you understand what's behind that.
Russ, I want to bring up a point there because the building that I managed when I started, we were 90% students because we were a block from the university. And in the ensuing years, the university built additional on-campus housing that took lots of units away from the private individuals. By the time I left that gig, we had less than 20% of our occupants students. Now, it was in a major city, one of the top 10 MSAs, and so we still were able to get tenants. They just weren't students anymore. Well, to Russ's point, if that had just been a college town and we had no visibility that the college had planned to build these units when we bought, well, that could have happened and it could have totally killed our business. So you got to do your homework. And we're not saying there's not going to be colleges, but you definitely want to take a look at the bigger picture. And with the trend that we've all been seeing, people are focusing a little more on getting out of bigger cities, not getting back in bigger cities. Just choose wisely. It's Ask the Guys. Your questions, our answers. We'll have more when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
When the world changes, investing strategy changes too. The coronavirus is disrupting economies, financial systems, and daily life like nothing in modern history. Sheltering in place might protect you from the virus, but a wait-and-see approach to investing now is like pulling the sheets over your head while the house burns down. It's not the time to be complacent. So we're calling our huge network of thought leaders, seasoned investors, and technical experts to find out what they're seeing, thinking, and doing to mitigate risk and capture opportunity, and we're recording all of it. We're calling it our Coronavirus Crisis Investing Webinar, and it's totally free. All you need to do is register. Remember, mainstream media doesn't talk to real estate investors. They don't understand you because Wall Street pays them not to. That's why the real estate guys are here. To register for the Crisis Investing Webinar, simply send an email to crisis@realestateguysradio.com. That's crisis@realestateguysradio.com. Real world wisdom is the best vaccine for a healthy financial future. Send your email to crisis@realestateguysradio.com.
If you want to learn how you could potentially increase your net worth by over $1 million and quit your job in just a few short years, listen closely for the next 60 seconds. This is Brad Sumrock, and over the past 16 years, I've helped thousands of people invest profitably in real estate, but not just any type of real estate. I specialize in helping people syndicate large apartment buildings so that they can be business owners and investors. In today's competitive environment, it's even more important than ever to leverage an experienced mentor, invest in your education, and have a team of advisors that has established relationships nationwide. And so many people right now seem to be struggling to find deals and then get them funded, but yet Sumrock students are thriving in today's marketplace. We've purchased nearly 7,000 units and nearly $1.5 billion in purchase volume over the past 12 months. And with the new Trump tax laws, apartment investors are positioned now better than ever before to pay even less in taxes. To find out more, send an email to apartmentsnow@realestateguysradio.com and you'll get my recent presentation called Why Apartments Now. That's apartmentsnow@realestateguysradio.com.
Hi everyone, this is Jim Rickers, the author of The New Case for Gold, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks so much for tuning into the show. Tell a friend about the Real Estate Guys, and if you have a question you'd like answered, go to the website at realestateguysradio.com and click Ask the Guys. We'll do another one of these shows in the coming weeks and months. Our next question comes from another Chris, this from Cabot, Arkansas. Hey guys, I come from the Midwest and I was in the Navy. Friends and I have found it difficult to find rentals with a large enough garage, larger than 2 cars, to work on various do-it-yourself projects. I like the idea of people being able to fix or build things themselves if they choose. I'm looking into solving this issue and believe the biggest hurdle would be to finance building the shop, as the house typically carries the value of the property. A shop with living quarters is also difficult to finance. As you can tell, I'm a newbie, but I can't be the only one who's thought about this, so I wonder, is the issue with financing, market demographics, or something to do with equity, property value? Love your show. I listen to you and Robert Kiyosaki quite often. All right, well, we and Robert appreciate that. Chris, here's the deal. What generally gets sold are things that people buy. So think about this. The 3-2 is the long-standing real estate winner. 3 bedrooms, 2 bathrooms. That's what people buy. Some people have 11 kids. They got a problem with the 3-bedroom, 2-bathroom. Some people don't have kids. They don't even need that second bedroom. But when you're a developer, when you're a builder, you're trying to build what appeals to the most people. You've hit on something that's pretty unique. And I bet there are other people like you that would like to have a little more garage space. I have a lot of garage space, and I'll tell you what, I'm very happy I do. But there's 2 other developments near where I live that are very unique. One is a through-the-fence development. It's a small airstrip, and there are 25 or 30 homes around the airstrip that each have a hangar and access out their back gate to get to the runway. So that is a super unique property, right? It's only going to be worth the extra value to someone who has and flies and owns a plane. So that's unique. The other one that's here is a horse property where there is a common area barn and stables that is connected to 8 or 10 different houses. And they pay a premium for that, but they're horse people. Rather than own their own horse ranch, they come together and they share facilities. So you've hit on something that people would be interested in. And I think there's a market too, but the financing part's going to be challenging. Now, the good news is it isn't expensive to build more garage space. That's generally one of the least expensive parts of the house. In fact, if you were to drive around my neighborhood, you'd see a lot of these bigger garages where they keep boats and RVs attached to 2 or 3 or 4 other garages where cars fit. And I will tell you, at least one of my garage spaces has never and will never have a car in it because I needed more space for stuff. So needing a shop and so forth, that's possible to do. But we always say don't let the tax tail wag the investment dog. And I think some of that may be true here. Don't have your particular need tail wag the development dog, if you will.
Yeah. So really, this is about understanding your market. You see something and your instinct is saying there's an opportunity here. I'd get around and see if there actually is some appetite. I do like the idea of kind of the co-op thing. I think that's a way to go. If you get a group of people together, the first step is, hey, if we were to buy a piece of property and build something in such a way that we had some common shop areas or work areas, would that be of interest? Rather than build these one-off properties that are only going to be of an appeal to a unique demographic. There's like people that do shared farms. It's like, I'd love to have a garden, but I don't really want to do all the work of putting in a garden. But, if 20 of us got together and we really bought an acre and had a big garden that would feed all of us, and we'd, by economy of scale, be able to hire somebody to run it and work it, and maybe that makes sense. So it could be another thing like that. As far as the financing part goes, financing is always the same thing. It's going to be about the return. It's going to be about the collateral, and bulk financing is going to be about kind of a cookie cutter approach. And if this is a real niche, you're going to need niche financing, probably private capital, maybe a community bank if you're really onto something. But you're going to have to do some homework first, not to dissuade you, because sometimes people who are innovators see something before the rest of the world. Obviously, there's a lot of do-it-yourself going on. Home Depot's doing well right now in the crisis, so you never know. But I would start with the common area thing and see if you can get any traction for that. And then if the market says yes, then you can go down the path of, would you be willing to get a custom build so you could have your own shop?
All right, great question. Our last question today comes from Rachel in Shawnee, Kansas. First of all, thank you for the intelligent, thought-provoking discussions you share on your podcast. I sometimes can't believe that the information I learn from you guys is free. Well, here's the thing about free information. It's only worth something if you do something with it, which is why our motto is education for effective action. But thanks for that, Rachel. Considering appreciation, community aspects, and ROI, are manufactured homes a good investment? I see some extremely affordable prices ranging from $5,000 to $20,000. I would love to hear your opinion on this. All right, well, we definitely have opinions. I'll start with mine. Manufactured housing is a lot of square footage for the dollar. So it's great from that point of view for the tenant if you buy it in the right place. The other great thing about manufactured housing is that the space rent is a very integral part of the total rent, and many times the occupant owns the mobile home or the manufactured house and not the ground underneath. So I'm a fan of owning the ground underneath. As far as buying a manufactured house and renting it out, well, not as much of a fan. You're not going to be able to get financing most likely for that. And there's a lot of damage that can be caused by low-end tenants, and they often do cause that kind of damage.
Yeah, I totally agree. I mean, the big advantage of, buying what effectively we'd call a mobile home park is that you end up getting the rent on the land. If you are only owning the home and not the land, then typically any appreciation that happens in the market is going to end up being absorbed by the land costs, and you're not going to see that. And the other big advantage when you're the owner of the park is that you're dealing with owner occupants who take pride in their residence. And if you're the owner and you're dealing with tenant mentality, and then you've got a landlord who's got the upside, I don't know. Doesn't sound like a great thing in my book. Not saying you couldn't find a right situation, but I wouldn't consider that to be a leverageable or scalable investment philosophy.
Yeah, Russ, I think you hit on it, which is the ownership of the land. If you own just, like we have a friend who owns several mobile homes that are on individual lots. He owns the land. He installed the home. He rents it out. It's no different really than renting a house, except that the loans aren't as good. But manufactured homes do have some lending associated with them. Most of the manufacturers themselves have financing if you're buying them new. If you're buying them used, that's a harder deal. But we are big fans of mobile home parks, and that's a story we'll save for another day. Hey, thanks for all your great questions. We couldn't get to them all, but we'll do another show like this in the coming weeks. So just get to the website at realestateguysradio.com and click Ask the Guys if you have a question, and fire away. Thanks for all your great questions. Until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.